liabilities and owner's equity. That's that accounting equation. It has to always, 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 always balance. Assets has to equal liabilities plus owner's equity, and any way you shuffle around that formula. The accounting equation, like I said, you've got to know it. It illustrates the balance sheet. For not-for-profit companies, the owner's equity is shareholders' equity. That's the difference between assets and liabilities. Owner's equity is shown on the liability side because a business does not own its net worth. So just some key things about the accounting equation. And assets, we kind of talked about that before. The difference between current and non-current assets. When you see current, you always think it's due within a year or less. And non-current are those assets that are of value or liquidity a year or more. And on the balance sheet, the historical cost of a non-current asset is reduced by the depreciated amount, leaving the net value of the asset on the balance sheet. Same thing with liabilities on a balance sheet. There's current and non-current, okay? Same thought. Current liability is something that the insurance company owes within a year. Non-current are those that would be paid or satisfied beyond a year. Shareholders' equity, it's also called owner's equity or surplus. It's the net amount of assets after you deduct liabilities. And it equals it includes the capital contributed by the owners and the accumulation of earnings retained by the organization since the beginning, since inception. And remember, because of the accounting equation, that if you have more liabilities than you have assets, then your policyholder surplus or your shareholders' equity would be negative, because that equation must balance. Okay, the income statement, like we said, is like a video, shows activity from a starting point to an ending point over a given period of time. And risk and insurance professionals like us can gain a better understanding of a company and its insurance needs by looking at the income statement. And the formula for it is there. Your net income is revenue minus expenses plus your gains minus your losses minus your taxes. And the purpose of it is to report profit or loss for the period. And different elements. There's basically two elements on an income statement. It shows your revenue or money coming in and expenses, stuff going out. And the insurance company's income statement more specifically, okay, your revenue would be premiums earned and income from investments. Your expenses are your losses, your loss adjustment expenses, your policy acquisition expenses, interest payments on outstanding debt, and general administrative expenses. And net income, why you care about net income is when you have problems on the exam where they say, oh, look at the net income, and you're like, well, you don't give me a column for that. It's revenue minus expenses minus income tax expense. Remember, we went on some of those questions, and I've got some of those to go over, and I will pop those up in a second. Gross profit. Gross profit is an income statement value that represents sales or operating revenue minus cost of goods sold. So you'll see that as a column on the income statement. And there's the formula. And your gross margin would be your gross profit divided by sales. So that's telling me what my margin is on my sales, how much my profit margin. Operating income. Remember, whenever you think of operating income, remember it's what it costs to operate the company. That's your gross profit minus your general operating expenses. Those are the expenses to actually run the company. Net income. Just talked about it. There's that formula again. And if your expenses and your losses exceed your revenue,